Welcome to the Sidebar with a CFP. Pierce the veil on BigLaw Life, career, and money. Hosted by Matt Smith, the tour manager for BigLaw attorneys. You bill in 6-minute increments. Let's get you some of that time back. In each episode, we will have candid conversations about life inside Big Law, the real stuff they don't teach in law schools or show in recruiter brochures. This show pulls back the curtain on what it actually feels like to climb the ranks, navigate transitions, and make big decisions in a high-stakes career. You'll hear from partners, associates, and experts across law and finance, each sharing stories, surprises, and strategies for building a life and career that works for you. This isn't a money podcast. It's a Life in Big Law podcast with a CFP in the host chair. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risks that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Now here's the host of Sidebar with a CFP, Pierce the Veil on Big Law Life, Career, and Money podcast, Matt Smith.
Hey, everybody. Welcome to Sidebar with the CFP. I'm your host, Matt Smith. I'm the tour manager for Big Law Attorneys. Today is a really great episode, very important and very timely because we're getting into tax season. Today is March 10th when we're recording the episode, and likely this will be published sometime in early April. So by the time you listen to this, you'll either have already filed your taxes or you'll be on your way to filing an extension if you're a K1 partner who needs to wait until October to file. But in any case, if you're a big law attorney, this is your annual reminder of how much you hate taxes and how much taxes take a bite out of your hard-earned dollars and income. And so when I am working with big law attorneys for their financial planning services, one of the very first things that I really require a client do is make sure they have a competent tax advisor. And one of those tax advisors that I love to recommend that my clients work with is Brian Leben. Brian is a partner at Lulloff, Leben Taylor, LLC. They're a tax advisory firm for which we have a number of mutual clients. And Brian has agreed to join me today in the middle of tax season to kind of give you big law attorneys an overview of the tax landscape, what we can do to help you, what maybe is not so applicable that you might hear on TikTok or Instagram. So Brian, thank you so much for being here. Welcome.
Thank you for having me. Appreciate it. Good to be on here.
So here we are, March 10th. Frankly, thank you so much for doing this at this time of year, because I know how busy you are. What do you see in terms of high income earners coming to you to have their taxes prepared and to maybe do some tax planning for the year forth? Are there any common issues or common threads that you see among the high earners?
I would say it's situational. Typically,
Yeah.
you don't even see them yet because most of them are still waiting for some sort of K1 or even a 1099 yet. So it's a little early in the season for the majority of them. But the most common issues is, how do I deduct that? Or how should we approach this situation? Or like a law firm has offered me a non-qualified plan. Should I go ahead and take advantage of that? And what does that mean? And what would that mean for me in the future? Things like
Yeah.
that.
Yeah. Do you run across a lot of attorneys or high income earners that are not sort of doing the very basics that I might think of as being super basic in terms of managing taxes, like maxing out the pre-tax 401k or using the health savings account, that sort of stuff?
100%. Yes.
Yeah. Okay.
And
So
it
yeah,
just, they don't know what they don't know.
right.
That's the majority of it.
Yeah. So, listeners, one of the things that I often encounter is someone will come to me and they say, well, I'm not maxing out my pre tax 401k because I heard that really I should only do what the firm matches. And either the firm match is relatively low and or there's no firm match at all. And so you feel like you don't have as much incentive. But those dollars are likely going to be saved anyway. And so saving them on a pre-tax basis, reducing your taxable income, this is one of the simplest ways to reduce your tax bill each year. And if you have a health savings account, it's similar as it relates to that. So, Brian, when people are waiting for these K1s, getting ready to extend and file in October, a lot of them maybe they forget year to year or they don't fully understand, but they still have to pay their estimated tax liability by April 15th, even if they do the extension. So
Yep.
how do you work
100%.
with that? How do you work around that?
So we try to take a look at and estimate what 2000, in this case, 2026 might look like, which is premature because we haven't even filed 2025 yet. But we'll take a look and just as much information as I have, we'll usually put maybe sometimes a healthy premium on top of it. So maybe we'll add 5 or 10% of the prior year, depending on their unique situation. And we'll estimate what their estimated tax payment needs to be at come April 15th here, and then June 15th, which is short behind.
Okay. So the way to think about that, another way to say that might be we want to make quarterly estimated payments throughout calendar year 2026 based on what we would have owed in 2025 so that we hit the safe harbor. Okay.
No, I
No.
mean, we don't know what 25 is going to be yet. So we don't even know what the safe harbor is going to be.
Okay.
So we can't necessarily hit the safe harbor. All we have right now at this point is the preliminary, in some cases, preliminary K1. In some cases, we don't even have preliminary K1. So it's the client, interviewing the client, the best guess. We'll use 24 as the base case and then estimate, what was 25 potentially higher than this, and what is 26 going to look like?
Okay.
We're
All
trying
right.
to own in and be a little bit more conservative if we can.
Yeah. Right. And so people, I have found on my end, and I don't know whether you see this as well, but oftentimes they're sort of shocked, particularly with that April 15th payment, because not only do they have the previous year's liability, but then if they're an equity partner and making quarterly estimated payments, they've got the first quarter of the current year due as well.
It's a double whammy. And then shortly behind, 2 months down the road, is June 15 already. It's a
Right.
shock from a cash flow standpoint, it's a shock for a lot of people. However, the worst thing you can do is not pay. I mean, I've had law partners before in the past where they literally forget to send it in. I had one, his K1 was hefty. It was about 850 or so, but he missed it by 3 days. It was about $4,500 penalty from the IRS just for 3 days. Miss.
Yeah. And so let's talk about the penalty a little bit here. I know for a number of years people felt like it was okay to pay the penalty because the interest rate on the penalty was so low, but I don't think that's the case any longer. This is totally putting you on the spot, but do you have any ballpark of what the interest rate?
So it had been in the 11 to 12% range,
Okay.
which is insane. And that's what you have to pay the IRS. But what they have to pay you was hovering in the 3 to 4%.
Yeah. Funny how that works.
Yes.
So when people miss their payments, if they get an underpayment penalty, I mean, it could really add up. Like you said, that was about a $4,000 penalty that person faced.
Substantial. That could be a long weekend vacation for there if there's something more right there.
Yeah. Yep. And that's why it's so important to kind of get a sense when your financial planner, when your tax advisor requests pay stubs and things like that, so that we can help you sort of project what that tax liability might be. That's why it's so important to provide that information so we can help you, because it can cover the fees very, very easily, just that
Correct.
one service
Yep.
alone. So what else do you see with your high income earners? I know that in my world, we're often talking about making backdoor Roth IRA contributions. Do you see a lot of maybe level 201 kinds of strategies like that? If the 401k and the
Do
same,
I mean the backdoor Roth IRAs? I would say is like the bare bones strategy.
yep,
So maxing out your HSAs, making sure you do your backdoor Roth IRAs. For some of our high net worth clients, we're getting them more of the super backdoor Roth IRA
hmm
strategies, if their employer allows that.
yeah,
And what that involves is that if your employer allows after the match for you to make non-deductible contributions to the 401k, then you can employ that. And then you also have to make sure that that employer allows in service, by in service means you're still working there, distributions to be able to execute on that backdoor Roth IRAs.
yeah. I think functionally for listeners, what we see when we're in your portal doing your 401k elections and things is like at Charles Schwab, for example. If your 401k is through Charles Schwab, they'll have uh, they'll have an option to contribute to your pre-tax account. They'll have an option to contribute to your Roth account. And then if you're one of the really lucky ones that has this sort of mega backdoor Roth potential, there will be a third option called after tax contributions, and you'll be able to select a little button that says automatic in plan rollovers, and they'll take care of it all for you behind the scenes, which is a really, really nice feature to have. And the benefit is that we're all familiar, or to the extent you're familiar with 401ks at all, you're familiar with the ability to opt into deferring into your 401k. So for 2026, you can defer up to 24,500 if you're under age 50. However, what you may not realize is there's still significant room left in the 401k that your employer could fill up on your behalf, whether that's with a match and or a profit sharing distribution they put in there. But there's a whole lot of room left. And if you have that after tax capability, you're allowed to fill up some or all of that space with after tax contributions. And it allows you to build up tax free for life Roth style wealth much faster than you otherwise would be able to. Because in a Roth IRA, you're putting away this year $7,500. You may be putting upwards of $40,000 into this after tax account in your 401k if you have it. And it can be really a game changer for your wealth over time. Do you see a lot of plans that allow for that? To me, it's more rare.
I'm seeing it more and more. Um, one, to make sure they can afford to do it, but I
Yeah.
still see um, it's probably less than 10%
Yeah.
that have enabled that. And some of this is just a lack of education on the plan sponsors. Where I've had some, in this case, law partners I've worked with, where we've gone to their compensation committee and say, hey, can you work with the sponsor of the 401k plan, go back and redesign to law these, and they're able to do those changes. So
Oh, wow.
there's certain windows allowed to do it, because most of the executives were interested. They just didn't know about it.
Right.
And
Yeah.
so you can make those modifications. It's more of a knowledge thing that it's the layperson doesn't know that.
That's very cool. That's great that you've been able to help enable that firm wide for some of these people. Do you get involved at the firm level with any of your, well, with a decent number of your clients, or is that kind of a one-off situation?
I would say onesie twosies. Some of
Yeah.
them depends how high they are, but most are interested in it. So they'll go back and talk to maybe their HR committee or their compensation committee, and they'll advocate for it. And then once in a great while, say, "Hey, would you mind jumping on a phone call and to explain this concept, what it looks like, so we can enable this for our entire practice. I mean,
Yeah.
I just see same thing kind of on the like I have a lot of physicians too, like same kind of thing where we're trying to work on that type of a strategy, um, and it's just a lack of knowledge.
Yeah. Yeah. So, okay, let's switch gears a little bit. I think what a lot of listeners are going to be curious about is like, how do I save dramatic amounts of money in my tax liability each year? For me, on my end, my clients are either W 2 earners as associates or they're K1 earners as equity partners. And what I find is that people hear about given strategies, through the grapevine, through social media, whatever it may be. And a lot of times, at least my opinion as the financial planner, is a lot of that stuff doesn't necessarily apply to them. But I'm curious from your perspective as the actual tax expert in the room, what kinds of opportunities do you see out there for these very high income earners to sort of manage their tax liabilities? And what are the potential trade-offs if they decide to follow those paths?
Yeah, it's go back to stock answer was it's situational because it
Yeah.
truly is. So I'll give you an example. Some of my clients that they have very hefty portfolios, but they've decided to go into real estate as a diversification, and the fact that you can depreciate a lot of assets, which then helps shields that from their 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 tax liability. Um, Others are doing more, I'll say, I've actually had a couple, and I don't recommend this, buy businesses, and they've not been successful because they bought businesses which they really didn't understand and thought they could run them from afar when it really takes someone to roll up their sleeves and be there day to day or hire a management team day to day. And it was a disaster from the start.
Yeah, I could not nod my head any harder. I mean, my head wants to fall off nodding when I hear you say that. That in so many instances, some of the strategies slash schemes that I see people try to employ involve an assumption that they can do this from afar, that it's not going to occupy a lot of their time or take up a lot of their resources. But using like real estate as an example, I have almost every client is interested in real estate, not just from an investment perspective, but also because of the tax benefits. Can you help educate me? Because I know just enough to be dangerous. I'm under the impression that much of the tax benefits of being a real estate investor won't apply unless you're actively involved in the management of the real estate. Is there nuance to
That
that?
is correct. So there's passive activity loss limitations, and so they can only take so much losses, and it doesn't really impact their overall um, taxable income as a whole. So let's say hypothetically you have $1 million of taxable income, but you have a rental property that might be running at $100,000 loss because you maybe had extremely high amounts of depreciation. Um, Usually it doesn't run that way because depreciation on a for residential has to be over 27.5 years. But there could be other expenses that are pushing it to a loss for whatever reason. And you're limited by what you can do. You can only take a very, very small fraction of that. So it's not really, it's kind of the main analogy is the juice is not worth the squeeze
Yeah.
because you're putting all that time in there. And at the same point, you don't want a midnight phone call if you have tenants like, hey, my heat's out or my air conditioner went out. And like, no, you just want to be left alone because now you have to either hire a management company in that situation
Yeah.
or you're going to have to, unfortunately, spend your weekend triaging the situation. So it's like the juice is not worth the squeeze for the most part.
Yeah, and I just to, put a fine point on it for some of the listeners out there, when we talk about running $100,000 loss, we're not talking about going into business to lose money. What we're talking about is the ability to depreciate some assets against your income, and in real estate that can work for you. But what I've seen in the past is people that believe they can sort of pass these tests to show that they are actively involved in the management. They're an active real estate investor. And the problem is, if you're billing 2,500 hours a year, working 3,000 hours a year, or whatever it may be, I would think that it's very hard to convince the IRS or an auditor or somebody that you're actually materially participating in the business of managing the real estate and hitting these various thresholds that they have.
There is a high bar, but even active real estates are limited to 25,000 of passive activity losses. So
Wow.
again, even clearing that bar, for the most high earners, the juice is not worth the squeeze.
Yeah. Yeah. What about, let me give maybe a positive spin on this, where I'll use a real life couple I have in California. One member of the couple is an equity partner at their law firm, and the other person in the couple is not currently working, but they are legitimately interested in running real estate business, doing the management of the properties themselves. In those kinds of scenarios, I think then maybe it really is a realistic, viable strategy for them to run, even if the net benefit of it isn't huge, but they internally, they're interested in managing real estate anyway.
Mm-hmm. I mean, from a long-term parking of assets and holding it for long term from a diversification strategy, it works. It absolutely does work.
Mhm.
Long term real estate, for the most part, except for some sectors, is a very safe investment. You get your steady returns, and it does offset things from like active investment income. It is kind of a hedge
Yeah.
from
Yeah.
that standpoint.
Yeah. So I don't want to be a wet blanket for everybody listening and kind of rain on everybody's parade for various tax strategies. There are situations in which some of these can work, but maybe let me do a little bit of kind of lightning round almost. Maybe you can touch on some of these strategies that I've had reported to me. So there's buying a heavy vehicle and then depreciating that, deducting it against your taxes every year. What is the real life version of that?
Um, that does work. So you do have to make sure that you are identifying the vehicles to make sure they qualify. There is Iris publishes that list, so it's not very difficult to find. Um, However, if you're a K1 partner, that necessarily is not a deductible expense for you. Now, if you're paid and I do have some of this like this where um, they might be paid as an independent contractor, things like that. They get a 1099.
Hmm.
That is a deductible expense, and there's a lot of um, different unique strategy for that. But also, if you're a 1099, you have self-employment tax liability to riff as well. But from that strategy, what I often find is that people will buy a car, and then every year or 2 years, they're trading that same car in for the next model of the latest and greatest. However, once you do that, because you were able to take so much depreciation up front, you then have to have that all recaptured. So the new vehicle is basically breaking even with the old vehicle. You're not
Yeah.
really even saving it.
So if I were to say that back to you, let's use an example. Somebody goes and buys $100,000 vehicle and they take $100,000 tax deduction
Mhm.
from doing that. When they go and trade that in or sell it next year or 2 years from now, they have to add that back to what
Right.
so they'd originally taken off 100. Now they have to add that back, and it sort of negates the effect of the.
Correct. So it's called a depreciation recapture, which is Section 1250 gain, which is taxed at a flat 25%. You have to get all that depreciation benefit you had in the years past is now recaptured, and it is
And for
offsetting your current depreciation on the new vehicle.
Yeah. And for the for my W-2 earners, I'm under the impression that in order to qualify for this, that the purchase of the vehicle needs to be like a business related
Correct.
vehicle. Is that true? Okay.
Yes, that's
So
correct.
it's harder for a W-2 earner to fit this into their tax planning. Is it not? Am I missing?
Yes, 99.9% of W-200 are not going to qualify for this.
Okay. Okay. What about conservation easements? Is this one that you see come across where
I
uh
do. Yeah,
yeah,
I'm hesitating when I hear you say that.
yeah.
Yes, but it's very difficult to um, qualify and play by the rules per se.
Hmm.
Um, so I mean, yes, that is it is out there. Um, it's not necessarily something that I would uh, recommend for the layperson.
Yeah, so I've had vendors contact me to promote their conservation easement strategies that I can go take to my high income earners to reduce taxes. And part of their sales pitch to me is that they have insurance and a cash fund to go through an audit every single year because they are going to be audited every single year based on the strategy that they're employing. And it just brings to light this concept of return on hassle, where I've seen people try to do things to manage tax liability that are really um, maybe not the most appropriate things for them to be doing, and or they're just so complex and so time consuming that they become not worth it. So I always kind of chuckle when I hear the conservation easement.
It's audit red flag as well.
Yeah.
So you'll see a lot of those promoters, and what they're promoting is like really might skirt the edges. And um, you've heard me say this so many times. It's like the juice that you might save is not worth that squeeze. It's just not worth
Yeah.
it.
Yeah. Okay. Another one, intangible drilling costs. Do you ever come across that where you are?
Once in a while, I'll see that too. People will um, like, oh, we can buy these, you get these credits too. There's things like that you've heard in the past where,
Mhm.
oh, good gosh, the Indian credits, that was a big thing within the last couple of years. And where the IRS literally came out and like, no, this is a fraud, this is a scam.
Yeah.
Um, and so it, there's, but you will see really some obscure promoters that are promoting all these different tactics, and it's not usually worth it for most people.
Yeah. Yeah. The list goes on. I maybe I shouldn't just sit here and rattle through a list of all these different things.
Well, I
I
mean, the
think,
big one is the home office. So
yeah.
the Augusta rule, where you're going to
Yeah. The
rent your
Augusta rule.
home out
Yeah.
for 14 days at some extravagant $10,000 a night, and be able to deduct all that and save on taxes. Um, doesn't work. So
What?
you can do something if you're, let's say hypothetically, you and your wife were a partner in maybe your own law firm, things like that. Now, the way this works, and it does work, but it's usually, again, not worth the time or hassle. You'd have to go and identify, hey, if I was to meet at a regular, like, let's say, hotel conference room, small conference room that accommodated us, what would the hourly rate be? And then I'd be able to document all that, have that documentation with me. Then maybe once a quarter, I could do that at my house. And overall, you might save what, $500 a quarter. It's not worth, a couple grand a year to do it, to go through all the hassle.
Yeah, I try and remind people the what I call the regulatory burden of a lot of these things, where you have to document so much kind of inane stuff that if you're ever asked to produce it, I think the way I've learned it is that when you're dealing with the IRS, they don't have the burden of proof necessarily. It's on you to prove and provide the documentation that everything you did, that you checked all the boxes, so to speak.
Correct.
And that can be, I imagine, a huge hassle just trying to do all of that stuff. And the other thing I try and remind people of is even if you go, a lot of these strategies relate to buying a capital asset or investing in a capital asset and then depreciating it over a very short period of time. But even if you, let's say you spend $100,000 on something and you get to deduct that 100,000 from your taxes, so you're going to save $37,000 in taxes. Let's say if you're
Mhm.
marginally at 37%, you've still spent whatever, $63,000 out of your bank account that if you weren't already going to spend that money, you're still a net loser on the transaction.
Absolutely right. So, what's the opportunity cost you could have been doing with that same capital?
Hmm. Yeah.
Big thing was I had a shared a story just recently. You're at a medical professional that highly compensated. His AGI was coming in. It was about 750,000. He wanted to spend 250,000 to get him below the $500,000 level, so he would be able to maintain the state and local taxes, which now increased from 10,000, which it used to be, now to 40,000.
Yep.
And so to save the $30,000 and miss in his deduction, he wanted to spend 250,000 to do a donor advice fund. I'm like, what? I actually told him, I said, write this down, think about it for a couple days, and then let's talk. And he called me a couple days later. He goes, yeah, that sounds pretty crazy, doesn't it? I'm like, yes, yes, it does.
Yeah. I understand, and I know that you understand also the psychological disdain for paying so much of your hard-earned dollars in taxes. And I get that. What I'm trying to do by way of talking to tax advisors like yourself who are on the up and up and have high integrity is show people that hey, some of these things that sound too good to be true, they often are. And even if maybe you could kind of finagle a way to take advantage of this strategy, you need to really understand everything that has to go into it in terms of the hassle and the work and the added burden that you have on top of your day job and potentially on your family, and really understand if that's worth it. Because often when you hear about these strategies, all you hear is a dollar value of tax savings, but you don't hear the other side of it, what went into it and or what came out of your bank account to make that happen. And in a lot of these cases, it's a net loss that if you weren't already going to buy the car, buy the farm, invest in the oil well, like whatever it might be, that it's just a net loser of money. So, okay, now that I've rained on everybody's parade, what are some things that people can be doing to mitigate their tax liability?
So the PTE tax deduction, make sure that um, it's easier to, especially if you're like a smaller practice, to be able to do that, employ that. So essentially, the law firm would be paying state taxes on your behalf, and then you get it passed through to you through your K1, and then you get deducted on your personal return. So it kind of gets around the state and local tax limits, especially now if you're over that $500,000 from an adjusted gross income, where that 40,000 is going to be quickly phased out. So what I'm
Yeah.
referring to is that this year, in the past, 2017 through 2025, you were limited to $10,000 state and local taxes. Now they've increased it to 40,000 under the OVA or new bill. However, once you hit $500,000 of AGI, it quickly phases out.
So, an example of state and local taxes, would that be for me in Texas? We have property taxes. I think that would be an example of state and local taxes.
100%. Yes.
So if I was paying $25,000 a year in property taxes, it used to be that I was capped at 10,000 in
Or
terms of what was deductible. Now that has increased. I think based on your earnings, I believe that's what you
yes,
just mentioned.
if you're under 500,000, you can get it all the way up to 40,000.
Yeah. So even for, for half my clientele that, they're going to be over that threshold in the first place. But with the PTE, you're able to have your law firm file taxes on your behalf in the states within the law firm is doing within which the law firm is doing business. And I think an additional bonus for that is that you don't have to file these individual state tax returns with your tax preparer every year and have an enormous tax package and all the associated
That
documents.
separate. That is a composite return.
Oh,
So
sorry, composite. Okay.
with the composite return, doing it like that. So the composite returns, yes, composite return will do the same thing. They'll pay the estimated tax on your behalf because they're filing it as part of the composite of everyone. And
Okay.
that is actually an oftentimes where I see, especially returns that I inherit from other preparers and or people that have tried to do maybe, let's say, the self-repair world on their own, is they didn't know how to apply the composite returns on their state tax returns. So
Yeah.
they had all this benefit, but they lost it because they didn't properly apply it.
And then filing an amended return in that situation, is that a 3-year look back or does it vary by state?
It varies by state. So, but if it's worth it, we'll definitely do it. I do those amendments all the time because either prior preparer didn't properly apply it, or especially um, if it's self repair, they don't know what they don't know.
Yeah.
I've seen self repair ones where they had composite returns for tens of thousands of dollars, but they claimed zero because they didn't even know how to claim it. They didn't know how to do it.
Man.
And so it's like, pay a little bit to competent preparer. You're going to save yourself way more money than anything you're paying to that preparer.
I'll tell this one horror story as we kind of get close to wrapping up here, that I had a personal friend who wanted me just to take like a once over of his financial situation. We weren't going to become client and advisor sort of professional relationship. It was just a personal friendship. And the very first thing I did, as I try to do with everybody, is look at their tax return and analyze that, run it through the software and things. And we discovered that they had paid twice what they owed in taxes the previous year because their tax preparer was also their financial advisor, who I think didn't have the bandwidth and was outsourcing some of the support. And essentially what happened was they added the ordinary tax liability as well as the AMT tax liability on top of each other. So instead of a $30,000 tax bill, this person paid 60. And so one of the first things we did is got with the tax preparer, different tax preparer, had them go file an amended return and get their $30,000 refund. But had they not done this, they never would have known. They would have spent $30,000 that they didn't need to. Um, and
It's
and I
kind of, you don't know what you don't know.
Yeah, you don't know what you don't know, and trying to save money, um, on taxes, when you're like in the top 1% of income earners in the country, trying to save money around financial due diligence is not the place to do it. It's you need to pay for competent tax advice because getting it wrong can be uh, devastating, really, and it can go on for years and years, and you may never know it, or it may be a decade before you figure it out.
Yeah, Matt, you hit the nail on the head there. The scary thing is a lot of people don't ever know that because they don't know that they don't know any better.
Yeah. So, okay, for me to summarize, I want to focus the summary on how to reduce your taxes because I think that's the number one thing that the listeners want to know about. And Brian, I want you to weigh in on this. My quick summary is going to be: do the simple things, get the simple things right. Max out pre-tax 401k, max out health savings account if you can do that. Be mindful of investment income and interest income and how that is taxed and where it comes in if you're in one of these higher tax brackets. We didn't touch on that, but there are things you can do in your investment accounts to mitigate the tax issues. And then finally, the last thing I would say, if you have a qualified, competent tax advisor who's going to do not only the tax preparation, but also help you with tax planning to look ahead, that in and of itself can be a massive tax savings by avoiding mistakes.
100% agree with you. The one thing you did point, and I see this all the time, especially where I see clients that have extremely high dividends
Mm-hmm.
or interest income. And it points back to your taxable investment account because they're in mutual funds in a taxable investment account, which is for the most part, a no-no. You should be in exchange traded funds, which are much more tax efficient. Mutual funds, especially some funds, put up extremely high active income, which you have to pay annually. Now, in a tax deferred account, which is your 401k, your IRAs, your rollover IRAs, you don't have to worry about it. It doesn't matter. It doesn't put up any active income. You can be in
Yeah.
a mutual fund all day long, but in a taxable investment account, you should almost never be in a mutual fund.
I'll adjacent to that is the high yield savings accounts that I see all the time. If you're in a 37% marginal tax bracket and you're paying net investment income tax on top of that, you might be paying 40% federal interest, let alone state taxation on those high yield savings accounts. And it may be a better choice for you to go into a tax-free like municipal bond fund or money market fund or something like that, particularly in high tax states like California, New York, those areas. So that's again, that's low hanging fruit for me to speak to a new client and just see, hey, you're in this high yield savings account that's generating 4%, but after taxes, it is dramatically lower than that. And for you, maybe a tax-free interest investment would be a better choice. So
Agree, 100% agree.
cool. Okay. Well, Brian, thank you. We're running up against the end of the hour, but I greatly appreciate your time during the busy season of taxings and appreciate your insights and hope that our listeners got a lot of value out of it. Thanks so much for being here.
Thank you for having me.
You've been tuning into Sidebar with a CFP. Pierce the veil on Big Law Life, Career, and Money with Matt Smith. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risk that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients.